All right, good morning, everybody. Let's call the meeting to order, December meeting for our retirees pension plan.
I can call roll call, Chad Bradford.
Yes, ma'am.
And then second,
Present.
Art Fury, Justin Campbell, Mark Liberty.
Present.
Okay, we have a quorum.
All right, has everybody had a chance to look at the previous minutes? Make motion to approve the minute.
I second.
Motion made, properly seconded. All in favor? Say aye.
Aye.
Motion passes. On to, we're on to Sawgrass, correct, Ms. Jill? All right. Good morning.
Good morning, everyone. Can everyone hear me?
Yes,
Yes.
sir.
All right, great. Good morning. I'm David Siegel. I'm not Leardon Gila. I know was going to make the presentation. I know he was coming down last week. He's out today, so I'm stepping in his place. I'm a fellow portfolio manager on your account with Sawgrass. So hopefully I can do a serviceable job in replacement of Leardon today. But just for the record, David Siegel at Sawgrass Asset Management. I can skip ahead. Do you want me to take control or share the screen on the presentation?
If you just tell me where you're going, I can do it.
Sure, absolutely. We can actually skip ahead. I'll jump ahead to page 9. And I'll try to keep it, I say so page 9 of, yeah, there we go. And I'll try to keep this somewhat brief, but there is a lot to talk about. The number one point to discuss is some of the performance and really the absolute performance in the bond market, which is quite frankly unprecedented in any time period we've ever had in the history of the bond market, which I'll show in a little bit. So I'll get into a couple of the reasons why that is and why we've had some of these severely negative numbers that we've never had before, looking on a quarterly basis, on a one-year basis, and the impact that those, although they're short-term, the magnitude of those negative numbers, the impact they've had as you look over 3, 5, 10, and even inception numbers as well. So looking at on a 1-month basis, the fund was, or your account was down about 4.5%. On a year-to-date and a 1-year basis, the account was very similar, down about a little over 14 to 14.5%, whether you're looking at gross or net. So these are severely negative numbers, unfortunately. And again, I'll get into why that is. We viewed our point in that type of environment to try to protect capital as much as we can. We entered the year with a short duration position, rising interest rates being the biggest factor that really impacted performance and impacted the bond market as a whole. We viewed our role in that case. We saw interest rates rising. We did go underweight interest rate risk as that rose and did a good job, I think, of protecting capital. As the year went on, as rates continued to rise, we became more into a neutral interest rate position. That hurt the performance to some degree. I'll show in a little bit. It wasn't just the interest rate position of being short or long or neutral. It was actually where on the interest rate curve you were positioned. We were underweight the longer end of the curve, so expecting more of a steepening. As I'll show in a little bit, the curve flattened to a magnitude it's really never flattened before. So again, we're looking at somewhat unprecedented times. We do think this is somewhat of a short period here where we're going to correct itself. There's not going to, these types of returns are certainly not going to be what we're going to expect going forward. But we do think our position will play out over time. Although we were able to outperform the benchmark in many cases, we wish we could have done a little bit better. And I do think as we move forward, we'll have a little bit of outperformance. And we've seen that even in the fourth quarter as we stand right now. So if we could go to the next page on slide 10. And this is showing the number one factor that's affecting every single market right now is affecting the economy. It's affecting the consumer. The number one topic on everyone's mind is inflation. And it's extremely high. And there's a lot of reasons for that. A lot of it go back to COVID. There was really a supply and a demand issue. The supply side was a lot of the supply shocks that were somewhat COVID related, not just in the US, but across the world. that were causing some of these supply constraints that were causing prices to go up and causing service providers and producers to really increase prices along with those supply constraints. And the double whammy was that on the demand side, we had a surge really post COVID, and a lot of the reasons, as the Federal Reserve had low interest rates and we had easy money and we had high demand, you had a fairly strong consumer and a fairly strong job market. So you had this double whammy of factors that came into place that pushed inflation to the degree that it is. What it was above 8% on a year-over-year basis. The thought of the mindset of the Federal Reserve is that these are going to be somewhat transitory. COVID would ease, the supply constraints would come down, the demand side would slow down as well. The consumer wouldn't be going on the pace that it was. The job market would slow down. They were clearly, they made an error in their calculation, I think, to put it lightly. And therefore, they had to catch up with interest rates. They had to try to catch up in rising and increasing their own rate. And you look at the next page on slide 11. So this is two things. So I'll look at the straight bar that is more of a staircase. That's the Federal Reserve effective rate. So that's the federal funds rate that they started to raise. You'll see it going back a couple of years was essentially zero. Back in early 2022, they started to increase interest rates by about 25 basis points at first, then 50 basis points, and then the last three hikes prior to the last hike were 75 basis points. So to put into context, there had never been a 75 basis point hike in almost 30 years. They did that 3 times just in 2022 alone, and then they ended 2022 in December with a 50 basis point hike. So again, it's I don't want to call it a panic move, but it was a catch-up move by the Fed as they were caught off guard by the levels of inflation. That other bar you see there is the 2-year yield, which again is usually somewhat in line with the Fed funds rate, and it was going back to 2020, 2021, and then you see it spike up from almost zero to over 4, or almost at 4.5% as we sit here today. So really, in such a short amount of time, you had interest rates rise exponentially. That type of interest rate increase severely impacts prices, and that's how you get it. When you see this across the entire Treasury curve, that's how you get these types of returns, these types of negative numbers, not just in your account, but whether you were in a core account, intermediate, even short-term fixed income was severely negative, unfortunately. So it was really hard to hide in any asset class for that matter, but especially in the bond world, it was really hard to hide from some of these negative price shocks that was caused primarily by interest rates. So I look at the next slide on page 12. I touched on the Treasury curve to show that it wasn't just any one part of the curve, but it was really across the entire curve. You look at the bottom table there, that's showing starting on a 1-month, 3-month, 2-year, 5-year, 10-year, 20-year, 30-year, showing how interest rates move. This is just over the quarter. So from 6/30 to 9/30, for example, the 2-year went from a 295 to a 228. So up about 132 basis points. What's interesting is, although the entire curve moved up, the front end of the curve, so that 2-year or the 3-month part of the curve, moved up, 130 or 150 basis points, where the long part of the curve, so the 10-year, moved up 81 basis points. The 30-year moved up 59 basis points. So although you saw rates increase across the entire curve, it wasn't just necessarily a parallel move. You really saw the front end of the curve move up more, and this caused more of an inversion within a lot of these interest rates. So you think about it anecdotally, you should get more for a 30-year bond. You should earn more yield on a 30-year bond than you would on a 5-year bond, for example, because you're taking on more risk over the 30-year time period. When that inverts as it has, it's typically not a good sign for the economy. Typically, any type of inversion in the bond market could lead to a recession. And we think that could very well be the case. We could be sitting in a recession as we speak. Even if not in a recession, it's clear there's going to be a fairly substantial slowdown in the economy. The level of inversion we're seeing right now, again, the magnitude of how large it is right now, so the difference between the 2-year and the 10-year, for example, is right at the range of the largest inversion we've seen. And typically these don't last very long. And the magnitude now, this has been going on now for a couple quarters, again, is somewhat unprecedented. So we do think as we enter 2023, Although we're in a bit of a slowdown, the bond market is very forward looking. So it's typically looking beyond the next step of where the economy may be going. So even if there are signs of a recession or signs of a slowdown, the bond market, in our opinion, has already priced that in. So we do think we're going to see a steepening of the curve. So you'll see the long end of the curve start to move up more than the shorter parts of the curve, and you'll see this inversion start to unwind a little bit. And that's how we're positioned right now in your portfolio. And though that hurt us somewhat in the in the third quarter and in 2022, we do think in 2023, this will be a big driver of performance as that treasury curve starts to unwind a little bit and starts to steepen. On slide 13, I know I've discussed just how large this negative performance has been. This was through the third quarter. So the negative 14.6% I'm showing there at the end of that chart is the Barclays aggregate through 9/30. So not necessarily for the entire year, but I think it's fair to say we're going to end up probably in double-digit negative returns. We've had a good fourth quarter, up about 3.5%, but we're not going to make up 14% in one quarter. So it's fair to say we're going to have a double-digit negative return. And you just look at where in the context of other, this is the Barclays, the Bloomberg aggregate is now called. These are the annual returns going back to the mid-70s. Typically, you don't see negative returns. And what you definitely don't see are any consecutive years of negative returns. We had a slight negative return in 21, and we're having a very large negative return in 22. So the good news is, although we've had this hit us very hard, this is the first time we've had consecutive years. We certainly don't think there'll be a third year of a negative return. But I think this at least puts into context just how much of a shocking bond market move we had in 2022. When you look at it previously, the largest negative return was about negative 2.5%. So sitting at negative 14.5%, again, just give some perspective on how large of a move we've had here, over 5 times what the previous negative return was. So on slide, let me jump ahead to slide 15. Slide 15.
The slide you're looking for, page 15.
No, I'm still seeing slide 13.
Oh, it's just, we're on 15, it must be a slow connection.
Okay, well, I can talk around it. Slide 15 is basically showing it, what the current attributes of the portfolio. So, I mentioned yields have gone up, interest rates have increased as much as they have. The good news is the yield on the portfolio as of 9/30 was 4.82%. So almost 5% yielding on a portfolio. And this is one of the reasons why what you typically don't see when you have a negative performance in the bond market and it's interest rate related, you typically don't see a prolonged period, because now you have the ability to invest at these higher interest rates. Now your bonds that were maybe earning 1 or 2% previously could be earning 5, 6, 7% now. So that's the type of return, or that's the type of yield, assuming you don't have continued interest rate rises, certainly not to the magnitude we've had. Now you have the ability to reinvest. Now your total return can be based on these much higher yields than what you had previously. So that's certainly the good news I think we expect going forward. We are seeing signs of that in the fourth quarter so far. I mentioned we have about a 3.5% return as we speak. And quite honestly, interest rates have somewhat stabilized. They haven't even moved down at this point. So I think if you have a stabilization of interest rates, or if you have a prolonged recession and there's a lot more fear in risk assets, for example, and a lot of that money goes into bonds and into U.S. Treasuries specifically, you could see rates start to come down. That type of move will start to reverse some of the negative returns that we've seen. So again, as shocking as maybe 2022 was in many respects, we do think the bond market is an attractive place to be right now. We are, personally, there still is risk in the market. I'm showing this shows your attributes here now that we're on the slide. I mentioned the yield of 4.82. We've become more neutral in duration ratio. So if interest rates stabilize or start to come down, we can take advantage of that move. Our credit risk is slightly above neutral at about 113%. I will say it's very selective. We're being very opportunistic with that. We understand there's still a lot of risk in the market. What we own is essentially single A securities, very high quality, very cash rich types of bonds that are issuers that we're holding. So we still do have some concern. But with that said, we also understand there's opportunities in the market because of some of the damage we've seen on the credit side. So we understand there's opportunities there. We do want to take advantage, but we are being very careful. But again, I think as we sit here compared to where we were about a year ago, there are a lot more opportunities now. There's a lot more interesting in the bond market, but we will be very selective, I think, in how we approach your account and your investments going forward. So I'll stop there for any questions. I know it's been a very interesting year so far. There's a lot going on, so I'll stop there. If there's any questions, whether either your account or anything just more macro or economic related.
I guess I'll wait till Burgess comes, but I had some questions about how they felt about that as well.
Sure.
Morning.
Good morning. I'm Mitchell Brennan with Burgess Chambers and Associates. Can everyone hear me?
Could we accept the Sawgrass report first before we start on?
Yes, ma'am.
Thank you.
Entertain a motion to accept Sawgrass report.
I second.
Motion. Motion been seconded.
I
All in
second.
favor?
Who made the motion?
Kenny.
Okay.
Okay. I guess we'll wait. Well, I'll ask my questions to Mitchell when we get to Burgess. Mr. Madron.
Yes, good morning. This is Dwayne Madron at Capital City Trust. And if we could page down to page 2, Jill, for the policy review, how the plan is positioned. And so currently, there's a little bit of an overweight to cash so as to hold some dry powder for buying possibilities. By the way, cash is now yielding 3.7%, which is very good. In fact, it's not too far from Sawgrass, so it doesn't hurt to hold a little cash. Large cap equities and international equities are underweight their policy targets so as to make room for the newer asset classes in equity, which is the infrastructure and the private real estate. Large cap equities is greater than international because business conditions in the US in general are better than those in Europe and China and some other countries. And the rest of the portfolio is neutral, except there's a little bit of an overweight to bonds because at this point, I feel bonds have less of a downside than do stocks in the middle of this turmoil that we're going through. So there's a little bit of an overweight to fixed income. Everything, all the asset classes are within range. We now have policy ranges, except for the REIT. That was an error. The REIT is now within range. I brought it within range about 3 weeks ago. So it's about 3, it's closer to 5. And so, trying to stay with Burgess Chambers strategic model as much as I can. When I deviate, it's not too far because over the long term, the model should produce a good return and perhaps meet the actuarial return, we hope. So if there's no questions on the policy allocation stance, we can move on to the account performance. For the equity side,
Yeah, I guess my question would be.
Yeah.
Do you think we need to change? Do we need to look at our asset allocation? Do we need to do something different, or do you think we need to stay where we're at? Our allocation? Yeah, do you think we need to stay with our asset allocation as it is? Do we need to think about making a change? Do you guys like the way it is?
No, I would defer to Burgess, but in order to meet your actuarial return, you need a healthy dose of equity. And that's what you have without being aggressive. You're borderline aggressive. But going forward, to meet that, I think it's 7.2, you need to have the car in fourth out of fifth gears. So I like it. In a down market, it hurts a little bit, but most markets are up. And in an up market, you don't want to miss the upside because you really need that to get to that actuarial return. Okay.
Yes, sir.
So looking at the third quarter performance as of September 30th, if you can page down a little bit, which would be the latest quarter, should be minus 4.36, and equities, fell minus 0.47. Bonds, high yield bonds were down minus 0.7. Real estate was down 9. So the third quarter, especially September, was not a good quarter. Year to date, equities have not performed as we would have hoped because of rising rates and a slowing economy. In fact, the equity portion year to date is down 20%, underperforming the S&P 500 because of exposure to international and small cap, which tends to underperform large cap in a down market. High yield bonds were down 12.9 year to date because they tend to behave like equities. Real estate, which is an equity-like asset, is down 17 because of its tendency to follow stocks. They both are sort of correlated with each other. But over the longer term, it's a different story. So, not a good year for investing at all. Unless you focused risk in certain assets, you did not do well. I mean, oil did okay, but as a prudent fiduciary, especially with the pension plan, you don't want to focus risk. You need to stay diversified. So last year, U.S. growth was great because of Fed stimulus. This year, it's less than 20% of what it was last year. So stock valuations are adjusting themselves to reflect the new growth environment that we are in. And then when growth picks up one day, which it will, then stock valuations will recognize that and earnings will improve and then stocks will move up again. That could be a while. However, the new fiscal year is shaping up nicely because October and November were great months. And so I don't know that the year-to-date total return performance, but I'm pretty sure that your stock side is up close to 13 or 14%. So out of the gate for the new fiscal year, we're doing good. So any questions on the third quarter performance? If not, we can page down. I just threw in October. In case you want to look at October, the latest quarter is -5. Year to date, the total fund, I think that's fiscal year to date. Let's see. Yeah, fiscal year to date, 6.29. So, no, getting better as we start the new fiscal year at the end of October. So that's just there for information. The next page, the asset allocation, is reflective of the total fund except the infrastructure and the private real estate, which are equity-like. So without those, you're 61% in equities. With those, you're closer to 70. So a moderate growth portfolio, borderline aggressive, but I will keep it underneath the maximum cap for equities, which I believe is 72, if I'm not mistaken. So this picture includes convertible bonds in the equity portion. So that's a hybrid, but we prefer to call that equities for purposes of this report. Then you see where real estate is yielding 3.6 and is at 2.9%. That's a little higher now. And so if you want to page down, Jill, the rest of the report are the holdings, the mutual funds that we own. Nothing particularly, nothing of interest to talk about, except that's just a reflection of what you hold, which are low cost, cost-effective mutual funds. And so are there any questions for me? If not, I'm finished.
Thank you, sir.
Thank you.
Motion by Lenny to accept the report.
Second.
Second by Sugden. All in favor?
Aye.
Aye. Motion carries. On to Burgess.
All right. Good morning, everyone. Thank you again. This is Mitchell Brennan with Burgess Chambers and Associates. And so we can actually start on page 18 before we flip back to the front of the report. Perfect. Right there. Yeah. So again, just to reiterate, Sawgrass, very unprecedented year. In fact, because of the downside we saw in both equities and fixed income on a fiscal year-to-date basis, this was actually the worst year, even worse than 2008. So you can see 2008, we were down 8.7%, 2022 fiscal year down 16.4%. So again, it's not unheard of to see significant volatility in equity markets on an annual basis. Equity markets are down usually about 14% at some point during the year. This year, we're down 25% at the lows in October. We've certainly rallied back from that since the end of since that low in October. But really what we've never seen before is downside in bonds to this extent. So you have to go back 50 years. We've only seen bonds down about 4 times. The biggest loss in bonds on an annual basis was about 3%. This year, bonds at their low were down 17%. And as of right now, are down about 12 or 13%. So again, that insurance portion of our portfolio, what's supposed to protect us and give us cushion when we do experience volatility in equities and our growth portion of the portfolio, unfortunately wasn't there, simply based on the Fed's actions in trying to combat inflation. As those interest rate increases significantly ramped up throughout the year, it really created some significant downside in bonds. So again, very tough year across the board. Even other safe havens like gold was down 8% through the first 9 months of the year. So really nowhere to hide. Wherever you had money, unless it was cash, you lost money this year. And so we can go ahead and flip back up to page 3. And so again, just to highlight on page 3, this shows all the major indexes, and you can see across the board down on a 1-year basis. Excuse me, page 2, go up one more, page 2. You can see again, across the board, everything was down. Unless you were in the energy or commodity related space, you lost money for the year. And so that takes us to page 4. For the quarter, we were down 405,000 or 4.7%, right in line with your target. The best performers were cash. We made a little money there. So one of the benefits of interest rates increasing is we should actually generate some yield on cash going forward. And then your high yield bonds held up a little bit better than your core bonds. They were only down 0.8% for the quarter. And then convertible bonds are down about 1.5%. If we go out for the full fiscal year, we were down 1.6 million or 16.4%. In line with your strategic model again, which was down 16%. And the best performers were cash, up 0.3%. Your infrastructure fund was only down 5.5%. And then again, high yield held up a little bit better than core bonds. It was down just 12.7%. Scoping out on a 3 and 5 year basis, still positive and still outperforming your benchmarks. Slightly underperformed your peer groups. But again, as we go into this new fiscal year, it does certainly look like you're starting to outperform. Just based on numbers that I pulled yesterday, you're up currently for the 2023 fiscal year, so starting September or October 1st, up about $427,000, or somewhere between 5.5% to 6%. So a great start. We've had some significant bounce backs in international specifically. Euro Pacific's up over 13%. Your index fund there, the FTSE index fund is up 16.5%. And then across the board, every single one of your funds for the quarter, current quarter that we're in, is positive. So again, a good start to the 2023 fiscal year. One thing I will touch on is when it comes to interest rates. So obviously the rise in interest rates have created some significant short-term pain, but longer term, it's going to be a great benefit to the plan. So if you recall, over the past really 5 to 10 years, we haven't had yield in bonds. So bonds have been down in that 1% to 2% range, looking at core bond yield. And so we called it TINA. There is no alternative, especially if you're trying to achieve a assumption rate between 7.5%. If you're only getting 1 or 2% from bonds, that's really pushed most allocations into more aggressive, more growth-oriented areas like equities, like private real estate alternatives, because we had to make up that gap that we weren't getting for bonds to get to that 7 to 7.5%. Well, now if we look at bonds, the current yield, so investment grade bonds are anywhere between 5 and 6%. Treasuries are up from essentially 1% up between 3.5 to 4.5%. And so we actually see some favorable environments going forward for fixed income, especially from a risk return standpoint. We look at when rates rise and rates fall, that impacts the value of bonds. Well, right now, if rates continue to rise, while that's negative for bonds, especially on the short end of the curve, you'd still be generating a positive return if we see another 1% rise in interest rates. And so we kind of have this asymmetrical risk reward where in bonds, we're still projecting positive returns, even if we see rates tick up a little bit further from here. Now, obviously, if the Fed continues to be significantly aggressive and raises rates another 2% or 3% to combat inflation, we would still see some headwinds for bonds. But at the current level we're at, and maybe 1% higher, it's certainly a favorable environment for bonds going forward. And then we can go ahead and go over to page 7. Again, this just kind of highlights some of the numbers I went over, but longer term on a 10-year basis, you still generated nearly 4.3 million in investment gains. And you've generated a total return on an annual basis of 6% net of fees. So again, when we look at a short-term view, very painful this past year, but longer term, the plan is still doing fantastic and generated strong gains over that time period. Page 8, this is our allocation. So just to highlight, we did allocate about a 7% allocation to private real estate on October 3rd. That was when the capital was called, about 640,000. So in the next quarter, you'll see that reflected in your asset allocation. Dwayne mentioned from an allocation standpoint, as of the 20th, so December 20th, we're still underweight domestic equity by about 4%, underweight international by about 3%, and a little overweight fixed income by about 4%, and a little overweight cash. And so we're certainly comfortable with that positioning. Again, we think there's a little bit better risk reward right now in fixed income, which is certainly strange to say when you see equity markets come down 25%, 30 to 40% in some of the more growth areas of the market. You'd expect to want to reallocate to those areas. But as of right now, we still think it's a little more favorable to be in fixed income than some of those growth areas of the market. So we're comfortable with those over and underweights as we sit right now. And then if we go to page 11, again, this just shows the longer term numbers and the individual funds. Certainly global infrastructure has been a big winner for the plan, especially over the past year when we've seen significant downside in all other areas of the equity market. It held up pretty well, down just 5.5%. And it's rebounded since the end of the quarter. So it's down about it's up about 8.4% since October 1st. Again, international saw some huge headwinds, and we've seen those rebounds. So the last two inflation reports came out lower than expected. So October's inflation came in at 7.7 versus an expectation of 7.9. November came in at 7.1 versus an expectation of 7.3. And so each time those reports have come out, the market has priced in that the Fed may slow down their future rate hikes, maybe take a pause. And so that's actually caused the dollar to weaken a little bit, which has been a huge tailwind for international. And so again, Europe Pacific's up about 13.5% since quarter end. And the Vanguard FTSE Developed Markets Index Fund, that's up about 16.5%. So a huge rebound in international, which was one of the areas that pulled us down for the past 12 months. Other than that, again, no updates as far as recommendations to rebalance or anything right now. We still want to maintain a little more conservative of a positioning going forward. We would expect some volatility going into 2023. Typically when markets bottom, it happens in 3 stages. And so the first of which is stocks fall, which we've already experienced. The second of which is we see earnings decline. And we really haven't seen the magnitude of earnings decline that we would expect in a market bottoming. So if you look at what's moved the S&P 500 so far year to date, it's been entirely valuation. And so earnings are actually up about 3%. For the year-to-date period, and so the entire losses of the S&P 500 has come from revaluation. So that price to earnings multiple. So what you're willing to pay for the earnings that are being generated, that's compressed significantly on a year-to-date basis, and so that's been what's caused the downside in equity markets. And so going forward, we're still looking for earnings to fall, and then that third stage would be the economy easing, so the U.S. going into a recession, which we're not quite there yet. We still have strong dynamics in terms of spending. We've certainly seen personal savings plummet since the height in the pandemic when everyone was saving money, and credit card usage increased significantly over the past couple quarters. But we're still not at a point where it's impacted the bottom line for companies and caused us to go into a full recession so far. So those last 2 stages, once we kind of see those unfold, that's when we would expect the market bottom to be officially in. And then from there, as a leading indicator, we would see equity markets start to rebound strongly. And so not quite there yet. Would expect some volatility through at least the first couple quarters of the year, and then maybe the later half of 2023 really see things turn around if we're not in a severe recession. And then with that, I will conclude my report and open it up to any questions.
I think you pretty well answered my questions with your report. I had some questions about asset allocation, but I think you're saying that we just sit tight.
Yeah. I tried to touch on that. And so I certainly think as we sit right now, I'd rather be a little more conservative. If we miss, a little bit of upside because we're conservative, I'm okay with that. I just don't want to get ahead of things and be too early and see some more downside. We were up going into this week a little bit more than expected. And so we've seen markets pull back a little bit. And so I think investors are still a little skittish. Again, until we see earnings fall and officially go into a recession, I think there's still some headwinds going forward. And so historically, the Fed has raised rates above the rate of inflation when they've tried to rein in inflation. And so right now, the Fed funds rate is between 4 and 4.5%. The last inflation report was at 7.1%. So we still have a gap there that we need to meet, whether that's the Fed raising rates even higher or inflation coming down. And so I would expect at least another 1% over the next year in Fed rate hikes, unless we see some serious reversion in inflation. And so it's trending in the right direction, but we'll see once we get the new CPI reports to start the year, what those look like and whether that calms markets.
And then do you generally agree with Sawgrass's point about they don't think they're going to see another down year in 23, another negative year in 23?
Yeah, I would certainly agree with that, especially we look at some data from JP Morgan. And so again, just looking at, they have a great chart that kind of views all the different areas in fixed income and what the impact of a rise of 1% or a fall of 1% would be. And certainly right now, that risk reward trade-off is asymmetrical. So the potential for a higher return is much better than the potential losses if rates go up 1%. And so, especially if you look on the short end of the curve, so just to kind of put it into perspective, 2-year Treasury is about 4.5% right now. And so the way it works is if rates rise 1%, a 2-year Treasury, you'd expect the market value to go down about 2% based on a duration of 2. And so if you're yielding 4.5%, you lose 2% market value, you're still generating about 2.5% return over the year. So again, on a 5-year, 2-year basis, those treasuries, again, you have a significant potential for return with a very low risk of losses, unless we saw rates go up another 2 or 3%, which right now I don't see that happening.
Thank you, sir.
Absolutely.
You guys have any questions? Entertain a motion to accept his report. I'll entertain a motion to accept Burgess's report. I second. Motion by Lindy, second by Sugden. All in favor? Aye. Aye. Motion passes. On to Klausner, Kaufman, Jensen, Levinson.
Hi, good morning, everybody. Can you all hear me okay?
Morning, ma'am. Yes, ma'am.
Okay, so just a few informational memos that we wanted to provide. The first is an important one. Recently, an act from Congress was passed that now allows for PTSD and acute stress disorders to be deemed to have occurred in the line of duty. This will allow for specific public safety officer death benefits and disability benefits to be awarded. Prior to this, PTSD was not considered to have occurred in the line of duty, regardless of medical reports. So we are pleased to see, to see that this has been added. Additionally, this act allows for surviving families of public safety officers who have committed suicide as a result of PTSD to apply for death benefits on their behalf, whereas that previously would not have been afforded. So the memo does, go into more specifics about what is required to be considered, but we feel that this is broad and we're happy with this inclusion. Just a note that this will be retroactive to January 1st of 2019. As of now, I don't see them going any earlier than that, but there is some current case law out there that's in the appeal stage. So if anything changes, we'll certainly let you know, but as of now, a safe assumption would be retroactive to January 1st of 2019. This next memo, let me make sure I'm looking at the same one. So there was a recent change in Delaware corporate law that had been the law for about 40 years. And it permitted corporations to include provisions in their company charter to protect members of the boards of directors from personal liability if there was a breach of their duty of care, unless they acted in bad faith or self-interest. This new change is going to allow this protection to extend to any director or officer. We are absolutely against this change in charter. In order for these companies to adopt this change, they will have to amend their charter, which will require a vote of the shareholders. That's why we included some suggested proxy policy language. Since the board does not vote proxies themselves, their managers are voting on their behalf. This is language that could be included in your investment policy guidelines. We can also communicate to the managers and instruct Burgess's office to do the same, that we are very much against this change and we would hope that they would vote no. So that's just suggested language. I believe the other plans added this language, and then they will, next time the investment policy guidelines are revised, we will add it in. So it's just an addendum for right now, which can just be done administratively. It doesn't need to go to city council.
So the other plans took a vote whether they wanted to accept that the attorneys are writing as a temporary measure until the investment plan is changed at some point in the future. But since we just changed our investment plan in the last 6 months, an addendum will do that job for us.
And it would be the same addendum, sorry, Jill, to interrupt, as the other plans, just of course the identifying names would be changed.
Do we need to go ahead and do that now? So we need to vote on adding this addendum to our.
Correct.
Okay.
Yep, an addendum on proxy voting.
So if someone will make a motion to add this addendum on proxy voting to our. So a motion made by Lenity to add.
I second.
Second by Sugden. All in favor? Aye. Motion passes unanimously.
This final memo doesn't require any action from the board, just informational that the SEC has adopted a rule to make proxy voting, which is what we were just discussing, more transparent to investors. So they're using a new disclosure form that will use a computer format, makes it easier to search. It'll disclose the number of shares voted, shares loaned, shares not recalled for voting purposes. So again, something we're happy about, just makes proxy voting easier for investors to understand. So just informational, does not require any action for the board. And that's it from me, unless there's any questions.
Thank you, ma'am. Appreciate it.
Thank you.
Will entertain a motion to accept Tension's report. Ms. Hannah's report. Motion made by Lenity.
I second.
Second by Sugden. All in favor? Aye. Motion carried.
The next item on the agenda is the meeting dates for next year. I presented these at the last meeting. Excuse me, for your consideration. These are the new dates that basically all the investment monitor and investment and Capital City has agreed on. These dates are about 3 to 4 weeks earlier than we had been meeting. And that's serves two functions. First, that if we can't get a quorum, we have additional time to set meetings for quorums. But more importantly, having the the American Core Real Estate, they need time in advance of the end of the quarter. We need to make decisions if we're moving anything in or out further in advance, before, because their quarter end is when things have to happen. This gives us a little more time to investigate and make decisions before their quarter end. So these are the agreed upon dates, and all I do is need a motion to accept these dates.
It doesn't cause us any problem that they're moving up from. ours.
I checked with Burgess, I checked with Sawgrass, I checked with Dwayne, and I checked with Patrick. And they adjusted some of these dates, so these are the dates that everyone is agreed on.
Sounds good. Yeah, we need to make a motion to approve these dates, correct, Ms. Chilton?
Yes.
Motion made by Lenity, second by Sugden. We're all in favor.
Next on the agenda is the quarterly expenditures. Well, they're more than quarterly, they're the entire year's expenditures. So you can kind of see where we stand. There was nothing very unusual in these, and I just need a motion to accept those expenditures.
Motion by Lenity, second by Sugden. We're all in favor. Thank you, Ms. Chilton.
Sure. There's no public comment or other business.
Accepting a motion to adjourn. Lenity make a motion to adjourn. Second by Sugden. All in favor. Motion.
Thank you, guys.
Thanks, everybody. I appreciate your time.
Thank you. Happy holidays.
Yeah, you as well. Thank y'all.
Thank you. Take care.
Bye-bye.